lot went on during the course of last year that we think warrants reflecting on because some of it does play a role in what we think is going to happen going forward in 2022. So we're going to recap a little bit of the main topics that went on last year, and I'll also kind of reference some of these topics that I think are going to be important going into 2022 because I think there will be a lot of continuation. So if everybody remembers back to the end of 2020, in the wrap up of the pandemic or the early stages of the pandemic, the government was sending out a lot of stimulus checks. And those checks went into the pockets of a lot of the average Americans. In certain small families, it was thousands of dollars that went into their pockets while they were forced out of work and home during the pandemic. And that money needed to go somewhere. And that really started the first theme of 2021, which was the bubbles that were created. A lot of our clients didn't feel these bubbles because the bubbles occurred in very speculative areas of the market, but they were bubbles nonetheless. So it started the year with what they referred to as the meme stocks. You could go to Reddit in other areas and you could find stocks being touted, and those stocks would then have massive runs only to come crashing back down. So that was kind of the first bubble of last year that happened. Really, a lot of it happened starting in late 2020 and certainly well into January and February 2021. And that led to the second bubble, which was the Spac Bubble, special purpose acquisition corporations, which had grown popular over the last few years. There was a flurry of new issuances that came out, and we saw a lot of SPACs spike up in price significantly, only to come again crashing down, some as much as 60 to 80% down from their highs. And then that led to the third bubble, which was the non-profitable tech companies that are out there. A lot of those were in the area of electronic vehicles and somewhat related to SPACs to some degree. But you saw a very significant spike in a lot of companies that were related to electronic vehicles, whether it be battery technology, charging technology, lithium technology, that had a massive run up only to again come crashing down. All these companies are probably going to be very good companies and be very valuable to us going forward as an economy. But the run-ups were a little bit unwarranted and we saw a significant crash. When the EVs or the non-profitable companies kind of came to the end of their crash, it happened to coincide with probably the last of the stimulus money that was put out there for families. So a lot of that stimulus money led to these early bubbles. From there, the narrative kind of shifted very quickly to inflation. Inflation was starting to show up in the economy. We were starting to see price increases going on. In the initial phases, the key word that was being kind of bantered about was the word transitory inflation. Inflation where, in particular, the Federal Reserve, the organization or the group in our federal government that's in charge of helping keep inflation under control, thought inflation was going to be transitory, which simply means that it's going to spike up very quickly, but then it's going to quickly come back down. It turns out they were very wrong. Inflation persisted much longer than they thought it was going to, and we ended the year with inflation somewhere in the neighborhood of the mid to upper 6% range, which is very high. And we do think that's a topic that's going to be very important going forward in 2022. How persistent is inflation? Do we see any sort of relief from the rising price increases? There are some few new terms that were kind of put out there related to inflation to some degree that have now become a little bit more trendy. We have to credit NPR for some of these terms, but one of them that I've talked to a number of clients about that I think is an interesting phenomenon going on out there right now in the marketplace is something called Skinflation. So companies are having trouble finding employees. They're having trouble finding resources. And they're also having trouble or concerned about passing along price increases. So instead, what they're doing is they're reducing services. So if you check into a hotel, you might not get some of the same services that you were getting before for the same price. And that was showing up in other areas of markets. It's really just, Skinflation is really just, you're paying for a service that 2 years ago was one thing, Today you're paying the same price, but you're getting something slightly less than that. That'll be something interesting to watch as we go forward. Does that persist? Can companies maintain their customers while providing lesser services? Do we get used to lesser services? The inflation narrative kind of also went along with what we would call the great reopening of the economy. Post-COVID, we had in the late spring early spring vaccines really started to come out and become much more available. By late spring, most adults in the U.S. were able to get access to the vaccine, and it led to the great reopening of the economy. They got out and about. They were spending money again. They were starting to travel again. They were starting to take on some of those things that they weren't doing during March of 2020 all the way up until the spring of this year. They really started to transition into spending money in other areas of the economy, which really led to the next big thing, a theme that still persists today, which was the supply chain crunch that is going on. A year and a half ago, if you had mentioned the term supply chain disruption to the average person in this country, they probably wouldn't know what you were talking about. At Christmas time, we had our president out there talking about, shopping early, or, don't be disappointed if you can't get what you want when you go to the store to buy your Christmas presents, because we're having trouble stocking the shelves. So now everybody knows about the supply chain disruptions. Again, that's a theme that we think is going to be persistent in a good way and a bad way going forward. And I'll talk about that more in just a second. But the supply chain issues really did lead to real problems in 2021. If you were trying to buy a new automobile, if you look at the average, car dealer's lot, you find inventory is significantly lower right now than it was, say, a year ago. Most of the time when new cars are coming into a dealership on trucks, they're sold before they get off the trucks. If you were trying to do a rehab on your bathroom, you might not have been able to get your countertops or your sink faucets. Virtually everywhere along the supply chain, there was disruption. We have a lot of clients that are in the business world. Virtually every single industry that I talked to this year had some semblance of a supply chain disruption. Going forward, we think that could be a big positive for the United States. In one area in particular, it's corporate America, I think, got very frustrated by this, and I think you might see a transition to a little bit more manufacturing in the United States, especially as you look at things like computer chips. Some companies have already announced some big plants to be built in the United States, so chips can be made here, so we aren't reliant on, foreign or emerging markets. COVID continued to be a pretty big issue in 2021. Early on, I think the thought might have been that vaccines were really going to help, and I think initially it did. People were out and about all summer long, really enjoying themselves, spending money, doing things. However, the Delta variant showed up later on in the year, and initially the Delta variant did affect the people that were unvaccinated or less vaccinated more. But then towards the end of the year, Omicron showed up, and Omicron does not seem to discriminate as much. It seems like whether you're vaccinated or not, and these are not scientific answers, so don't hold me to this, but whether you're vaccinated or not, it seems like you can be infected by it. Now, the good news, or at least the apparent good news of the most recent variant, is it does have scientists starting to talk about moving from pandemic to endemic. It's a much less deadly variant, or appears to be a much less deadly variant. It appears to make us less sick, and we may now be transitioning to the stage of this pandemic that transitions us to endemic, which would, I think, be a very welcome sight for all of us. Now, again, I'm not trying to speculate here. I'm only repeating some stuff that I've, recently read. So 2022 will play out. COVID will continue to play out, and we'll see where this transitions to. 2021 was a great year to own assets, right? Why? Simply because they appreciated in price. If you own commodities, we had a pretty decent allocation to commodities in all of our bond accounts, and in our stock accounts, and commodities did very well last year. They were the big winner from a public investment standpoint. Stocks did very well, especially US-centric stocks. Some of the foreign European stocks lagged behind a little bit, but they still had positive returns. So last year was a great year to own stocks. Real estate did well. You had price wars going on. You know, in the middle of the summer and into the fall, if you were looking at certain markets, such as maybe Florida or California, houses were getting multiple bids before they actually even hit the marketplace. We're located in Watertown, New York, and you had housing up here that was seeing multiple prices on houses on the first day they were listed, which is unusual for our market. So it was a very good year to own housing, or own really a lot of other real estate outside of probably some retail space and outside of certain commercial space, which is still rebounding as people go back from working from their homes back into office type space, but houses were good. The only areas of the public markets that were not that great were bonds and gold. Both of them were kind of blah last year. Just minor negative returns on each of those. They weren't, they didn't harm your portfolio per se. They just didn't really help. And the reason for that is simply those types of investments are more defensive. And last year, the more you took offense, the better you did. The more aggressive you were, the better you performed. I don't think that will continue quite that unabated in 2022. I think you're going to see a transition in the stock market where we're transitioned from maybe some of the higher risk, higher growth stocks to more of the value stocks, more of the, maybe some of the industrial type stocks, where we see some things going on in the economy that can be very, very beneficial to them as we continue to rebuild coming out of COVID. Now, who knows exactly how that play out, but certainly last year, defense didn't work. Even in the stock market, if you own the more defensive stocks like the healthcare stocks, yeah, you still made money, but not as much as if you were more on the aggressive side. For instance, the most profitable area, the sector of the markets last year were the energy stocks. Well, coming out of COVID, those areas of the markets where there was the most fear. Were we going to need to fly on planes again, or were we going to want to fly on planes again because of COVID? Were we going to want to travel? And all of a sudden we saw, a good recovery in the energy sector, and the energy market led the recovery back last year. The other thing that really did well last year is corporate profits. Corporate profits now are not only back to pre-pandemic levels, are now well past the pre-pandemic levels. Which is just a sign that the consumer is out there spending money. People are out doing things again, and it's leading to good economic growth. And the bottom line is, as corporate profits go up, the stock market will go up. In the long run, profits and stock prices tend to follow each other. All right. Prices usually go up in advance of profits, but usually go up because the prices are going up because people are pretty confident that profits are going to grow. So as profits keep growing, we expect the prices of stocks to continue to follow.